Okay, for this video I want to cover the IRS Form 8283 for non-cash charitable contributions, and specifically I want to talk about the rules in a scenario where the taxpayer donates appreciated publicly traded stock to a foundation. So what we're going to have here is John taxpayer has his own private non-operating foundation, and he decides to make a charitable contribution to that foundation of appreciated publicly traded securities. So I'm going to go through the 8283 with John's 1040, so it's a part of his complete 1040 return here. So we'll go through all these pieces. And then I do have two slides here that cover some of the background rules on property contributions, and then again specifics on donations of stock to non-operating foundations, and then more details on the fact pattern. So first slide, some background on property donations. So when we complete 8283, this is used to record any kind of donations to a charitable group that are non-cash, right? That's really the standard here. So you can donate cash, those amounts just get reported on Schedule A. If you donate property of any kind, you should be completing an 8283 and reporting those details on that form. Now, a little bit on the limits on deductions, and this is really important because we're going to see how the limits vary between public charities and non-operating foundations. So when we talk about how much can we actually deduct when we donate these amounts to charities, there's really two big questions. The first one is, what type of property are we giving? Right, so is it cash or is it some other type of property? Is it ordinary income property, capital gain property? We'll get into those details, what those elements mean later in the video. And then the second piece is, okay, we're giving away this item, this cash or this property, but who is the recipient, right? Is it a public charity? Is it a private operating foundation? Is it a private non-operating foundation, donor advised funds? All of these elements matter as well, because that also drives whether we can deduct the item and what are our limitations and what are the rules on how we calculate the deductible amount, right? So let's start with cash, right? Because cash is easy. So when we donate cash to a public charity, the donor can deduct up to 60% of their AGI during that year, right? So the standard used to be 50%, but the Tax Cuts and Jobs Act modified that to increase it to 60% through January 1st, 2026. So if that's extended, then we'll keep the 60%. If it expires, then we go back to the 50%. Now, cash for non-operating foundations, if you donate cash to a non-operating foundation, you get a tax deduction, but it's going to be limited to about 30% of your AGI. So there's going to be a ceiling that you're going to have to worry about. And that's going to be the subject of this example, is we're going to see how contributions of cash or property to non-operating foundations is treated much, much differently than public charities. So what are the rules when we look at property itself? So donating property to a public charity gives the donor a deduction of up to 50% of their AGI. So that 60% limit, when that was changed under the TCJA, they only made that change for cash. If you donate property to a public charity, you get that deduction, but it's not a 60% AGI limitation, it's just 50. Okay? Now, what about how do we figure the amount of the deduction, right? So the amount of the deduction is going to matter depending on what kind of property is and whether the value decreases or increases. So most people are going to find themselves in this second bullet point here, right? When we think about donations of property to charity, the value has always decreased from when we originally bought it, right? If you buy, like in this example here, if we buy a couch many years ago for $1,500, it's brand new. If we're using it for personal use and then we donate it many years later, the value is going to go down. It's not going to go up. So the deductible amount as a non-cash contribution is going to be the $600, not the original cost basis of $1,500. So what do you do in those rare occurrences where you donate property where the value has increased from your original basis or your adjusted basis in the property? So the amount that you can deduct is still the FMV, but it might have to be adjusted. So in this example, we have, let's say we donate publicly traded stock that we held for only 8 months. So it's short-term capital gain amounts. It's considered ordinary income property for purposes of these rules. If the fair market value is $5,000 on the date of donation, but our cost basis was $3,500, we have $1,500 of short-term capital gain appreciation. Now, we donate the stock to the charity. We have to lower the $5,000 FMV by the unrealized appreciation, and so our deduction is limited to $3,500. So even though we donated property that is worth $500, we can only actually write off $3,500. Now, with stock and other types of property, there are different rules, right? So there's different rules that apply to capital gain property that was held long term. And that's one of the exceptions we're going to see with this fact pattern here. All right. So the donations of capital gain property to a public charity will give the donor a deduction of the fair market value. So they don't have to take the fair market value and reduce it by the unrealized gain. They can still deduct up to the FMV of the property. Okay, so now let's talk about some specifics that apply to these non-operating foundations. So non-operating foundations, do not confuse these with public charities. Non-operating foundations are generally set up by individuals or families, and the individuals or families are really the only ones that are contributing money to the foundation. They're the only members of the board, they're the only directors, they don't solicit donations from outside third parties, so everything is kind of contained within one individual or a family setting. And so for these reasons, they have different rules. So when we donate cash to a private non-operating foundation, the amount of cash that we can deduct or write off on Schedule A is going to be limited to 30% of our AGI. And if we donate property to a non-operating foundation, it's capped at 20%. So notice there's quite a big difference when it comes to non-operating foundation donations or if I donated money to a public charity. Right? Public charity, I get a 60% AGI cap or for cash and a 50% AGI cap for property. So if we look at the deductible amount of property donations to a non-operating foundation, it has to be reduced by any gain that would be recognized if the donor sold the asset. So for example, if John purchases land for $150,000 as an investment in 2005, and then he donates the land to a private non-operating foundation when it's valued at $275,000, his deductible donation is going to be limited to $150,000, and this is because he has a $275,000 FMV, but he has unrealized gain of $125,000. Now, that limitation applies to, again, it's property donations to a non-operating foundation, even if it's long-term. So here's the exception, right? So there's an exception that applies to capital gain property that is also characterized as qualified appreciated stock. So what is capital gain property? Capital gain property under Section 170 is going to be any capital asset, the sale of which at its fair market value at the time of donation would have resulted in a gain that is long-term. So if you have an asset, a capital asset, and you're holding it long-term and you sell it, or you would have sold it, right, on the date of donation, the holding period would give you long-term capital gain. So that's the first element that we have to meet. The second piece is what is qualified appreciated stock. So under Section 170, QAS, or qualified appreciated stock, is stock of any corporation for which market quotes are readily available on an established securities market, and it's capital gain property. So what does that mean in regular speak? If we have publicly traded stock for which we have a long-term holding period, we get this qualified appreciated stock exception. And so that's what we generally see as far as donations go with non-operating foundations. We have, wealthy individual contributes qualified appreciated stock to a foundation, and they get the full FMV as a tax write-off on their taxes. So let's look at our John Q. taxpayer example here, and then we'll look at his return. So we have John wealthy individual formed his own private foundation several years ago, and the foundation is characterized as a non-operating foundation for federal tax purposes. Non-operating generally means that the foundation itself isn't conducting any direct charitable activities. It is pooling funds and then is dispersing those funds to other charities, right? So in 2022, John donated 1,300 shares of appreciated Apple stock that he originally acquired in 2019 for $54,000. John donated the shares on November 18th, 2022, when the FMV was 196. So, what does John do here? Well, his donation of that publicly traded stock is going to be capital gain property because he has a long-term holding period on it. And it's qualified appreciated stock, right? So it's stock that's regularly traded on an exchange. So he has, good fair market value, market quotes to be able to value the property. So the charitable contribution amount for John is going to be the fair market value of the stock. So, but again, he's also got this 20% AGI limitation because it is non-cash property. So if we look at John's return, we're going to see that his AGI is a little 950,000 roughly. So his 20% limit is going to be 189,346. But the charitable donation is 196,300. So he's going to have some excess that's carried over. All right. So let's look at the return itself. And we'll see how these numbers actually fall onto the form. So this is John's 1040. So John's got his wages up here. He's got some investment income, right? So qualified and ordinary dividend income, capital gains, a little over 400,000, some other income. So his AGI for the year, before computing that limitation, is $946,732. So now if we have a look at the 8283 where we report the contribution, so we have non-cash charitable contributions. Part 1 is used, so Section A, Part 1 is used to report donated property of greater than $5,000 or less, and any kind of publicly traded security. So even though the publicly traded securities donation is going to be more than $5,000 because it's publicly traded stock, we still report in Section A, Part 1. So the name of the donee organization, so this is the recipient organization here, is John's Foundation, John Q. Taxpayer Foundation. And description of the property there, we have 1,300 shares of Apple stock. Date of contribution, the date he acquired the shares, how he acquired them. He did it by purchase, right? So we just purchased it through his brokerage account. And so we have his original cost basis there, $54,600. And it was not adjusted over the years, so he didn't have any non-dividend distributions or anything like that. And then the FMV on the date of contribution, right? So $196,000, $196,300 rather, right? Okay, so his Part 1 of Section A is complete. That's all he needs to do on this form for this type of donation. So publicly traded securities, we don't need appraisals because we can just use the current market data because it is publicly traded stock. And so this is all set. So the 196,300, now generally when you have the non-cash FMV amounts, you can normally just report all that on Schedule A. But remember, there's limitations here, right? So normally non-cash charitable contributions are reported on Schedule A, line 12. And then if it hits that ceiling, then there's a carryover amount. And so we can see here that we have reduced it by the 20% of AGI limitation, right? So John's AGI, if we go back and we look here, so remember his AGI is 946,732, and he's got a 20% cap because it's property going to a non-operating foundation. So 189,346 is the most amount that he can record as a deduction for this year on his Schedule A. So when we look at Schedule A, we've got the 189,346 amount there, and then the excess amount is being carried forward to future tax years. So John did complete worksheets. So there are helpful worksheets that you can use to calculate any phase outs that might apply. So this worksheet is available in the publication as far as applying the deduction limits. So we can see here on line 4, the actual contribution to capital gain property was $196,300, so that's the gross amount. That's his AGI figure, $946,732. And so at the bottom here, we can see the contributions subject to the limit based on 20% of AGI. This is where he's computing that limitation. So we've got the $189,346 cap, and then the excess of $6,954 is being carried over, right? So you can also create a carryover worksheet here, right? Contributions that were subject to the 20% of AGI limit, capital gains property, $6,954. So John can roll that forward to the future year, and if he itemizes his deductions, then he can apply that as a carryover amount. All right. Okay, so that covers it for this video. I hope that was helpful. Again, remember, this is specifically targeted towards non-operating foundations, so those have different rules, as I highlighted on the slide. So again, always make sure you're being very careful as to what type of property you're donating and what kind of organization is receiving it, because that's going to really impact the rules as far as how much can you deduct and what are going to be those AGI limitations. All right, so thanks so much for watching, and I look forward to seeing you again on the next video. Thanks.